Chapter 4, we talk about completing the accounting cycle. And it starts with a worksheet. So the worksheet is basically just kind of it's not a requirement. Sometimes accountants will use it to help them reconcile. So here's an example of it, and this is showing it in Excel, which would be a nice way to do it. Your account balance, or I'm sorry, your account title here, what your trial balance came in at, and then what adjustments you needed to make. Then that creates your adjusted trial balance, and then you pull the accounts to the income statement and the balance sheet. So here again is our showing you kind of the individual detailed steps. So your trial balance comes in with all your debits in one column and your credits in the other, and obviously it balances. Then we could add in the next two columns where we've got our adjustments, and those adjustment entries are what we did in the last chapter, but now we're just kind of funneling them through this worksheet or this spreadsheet. And then that creates our adjusted trial balance when we take the trial balance plus those adjusting entries, like what we did in chapter 3. Then we go through the accounts and we put them where they belong, whether it's the income statement or the balance sheet. So again, to refresh back to prior chapters, the income statement has our revenues less all of our expenses. Revenues are regularly a credit balance, expenses are regularly a debit balance. Then your balance sheet, your assets are regularly a debit balance. Your liabilities and your equity are credit balances. And then as your dividends are paid, those are a debit balance as well. Okay. Then we've taken it one step further to say, okay, my revenues less my expenses provide me with net income. And then that net income is going to roll over into our retained earnings account, which will end up on our balance sheet. So again, the income statement is prepared from those columns. The balance sheet and the statement of retained earnings are prepared from the balance sheet column. And again, here's our finished product of our income statement with the revenues less the expenses, our statement of retained earnings where our net income rolls in, our dividends are paid out, and this is what the company retains. And then that also funnels over into our balance sheet where again, we've got our assets less our liabilities and our equity and our retained earnings. Again, funneling in from that statement of retained earnings. And then note up here, this is a little bit different now that we've added our adjusting entries. We have our equipment less our accumulated depreciation, and then that net total funnels over into our total line of our balance sheet. So this indented line is more of a subtotal type column that then carries over the total to the far column. The adjusting entries, again, are prepared from that adjustment columns, and those help to create our financial statements. Our second learning objective is to prepare our closing entries and then our post-closing trial balance. So you do have questions on your test that deal with what accounts are temporary and what accounts are permanent. So it's good to understand those. The general basic understanding of it is all of your income statement accounts are temporary. So your revenues and your expenses, those will go for a whole year. So say your fiscal year is January 1st to December 31st. Those continue to accumulate all during that year, but then at the end of the year, we're going to close them out and make them go down to zero. Your balance sheet accounts are all permanent, so they continue on as long as there's a balance. Like when you have cash in the bank, you're at the end of the year and you look up your bank account, you've got $30,000 in there. It's not going to zero out. You don't have to pull that money out. January 1st, that $30,000 is still going to be there. If you have a car and it's valued on the books at $10,000 on December 31st, January 1st, it's still going to be there. Or if you have a loan on that car of, $7,000 on December 31st, again, January 1st, you still owe that loan. So these ones don't zero out and they don't start over every year. We just carry whatever those balances are at the end of the year over into the new year, which is logical. If you think that through, it's the logical thing that has to happen. Then we do our closing entries, where what we're going to do again is zero those out and transfer the net income over into retained earnings. And then the dividends are also closed out into retained earnings. And when we do these closing entries, it will produce a zero balance in all those temporary accounts that are on the income statement. So we've got, again, all of our revenue accounts and our expense accounts. Those get closed into this temporary account called income summary. And then that income summary account is closed into retained earnings. Dividends are closed directly into retained earnings. So here it shows you the entry. So this first one is our service revenue closing into the income summary. And since we're zeroing out that service revenue, it would normally be a credit balance. We are debiting it to zero it out, and the credit goes to income summary. Then we take all of our expenses, which would normally be a debit balance, and we credit those, and then that offsetting debit goes to the income summary. Then we look at what's in the income summary, which should equal our net income, and that closes into our retained earnings. And then again, the dividends close into the retained earnings. So these would be the closing entries that you want to be able to understand how to do. And it's helpful if you know the account's regular balance. That's very helpful, because then in the closing entries, we're going to reverse those. Okay, and then this just shows it kind of funneling into the various T accounts. Then here we have our post-closing trial balance. So then you can see all that's left is our assets and our liabilities, and then the retained earnings. So the net income less those dividends paid. And then that is our post-closing trial balance, and that's going to roll then start into the next month or year, whatever, in this case, we're in a month. So starting November 1st, that will open back up. So here we have the various different steps that we go through the whole accounting cycle. So again, analyzing our business transactions, making journal entries, posting them to the general ledger, preparing a trial balance, then journalizing any of the adjusting entries, preparing that adjusted trial balance, preparing our financial statements, then our post-closing entries, and our post-closing trial balance. So that's our full transaction. So here we have analyzing our business transactions, again, kind of back to that very first step. Our accounting equation is assets equal liabilities minus our stockholders' equity. And we've got some of the numbers that are funneling in there, and coming out again, we're balancing on both sides. Then we've got journalizing our transactions, again, all of the journal entries that go in to the ledger, and we post them directly into each account. Each account's it's got the debits and the credits, and then coming down with what their total for that month is. We prepare a trial balance with those balances that come off of those individual T accounts. Then we make our adjusting entries, so accruals, and if we used up supplies, or we're allocating out prepaid insurance, and we're recording depreciation, all of those things that we talked about in the last chapter would be our adjusting entries. After those are in, then we prepare an adjusted trial balance, and this shows you that in red, these are all the numbers that were adjusted based on those entries. And then we prepare our three financial statements: our income statement, our statement of retained earnings, and our balance sheet. And again, they flow just like we've talked about in the past. Net income goes into retained earnings, dividends are paid out, and then that ending retained earnings goes into the balance sheet. Then we close it out. So then again, we close out our revenues to the income summary, we close out our expenses to the income summary, and then we close the income summary into the retained earnings. And then this is our post-closing trial balance. So again, you can see it's all balance sheet accounts. We have no income and we have no expenses once we do our closing entries. So again, just make sure all your accounting records are free of errors. And you really want to do that before you close if you can, because it is a little harder to make those adjusting entries once you've closed. So hopefully those are all posted. Okay, so that is again the process and the big picture and bringing it all to an end.